I'm Anastasia Moroso here in the iCapital studio. On this all-new episode of Beyond 60/40, we're focusing on structured investments, and I speak with RBC's Amy Wu Silverman, who shares how options can be a leading indicator for markets. And then Morningstar Chief Product Officer Vimal Vel lays out how technology and data are increasing access to alternatives. And as always, I share the one thing that caught my attention this week in private markets. Take a look. In today's Private Market Pulse Snapshot, the one thing I'm focused on is the secular and cyclical factors driving the semiconductor industry forward, and why using structured note investments with downside protection might be a timely way for investors to position in this space. Since the start of 2023, semiconductor stocks have been on a tear, with the broad semiconductor index surging 87%, surpassing the S&P 500's gain of 32% by nearly 3 times. And despite industry revenues falling 8.2% in 2023 relative to 2022's record levels, the semiconductor index actually posted its highest annual return in 23 since 2009. Still, even with this notable move higher, we think that a combination of near-term cyclical drivers and longer-term secular factors should continue to support semiconductors. Now, from a cyclical perspective first, in recent quarters, inventory levels have come into better balance, and remember, they've been elevated post-pandemic because of the surge to restock. Now, total inventory days across producers, manufacturers, distributors, and customers have collectively declined by 20 days since the second quarter of 2023, although they do remain elevated at 58 days, which is 25% above the longer-run median. Now, we may still be in a period of structurally higher inventory because we remember, of course, all too well the shortages that we experienced at one point during the pandemic, given those supply chain disruptions. But signs do point to further normalization as chip demand enters an upcycle. Semiconductor demand tends to be highly correlated with manufacturing surveys, and recently we saw the ISM manufacturing number enter expansion territory, and that should be positive for chips. Indeed, revenues, which fell in 2023, as we noted, are expected to increase by anywhere between 6 and 8% in 2024 as inventories are declining and shipments are matching demand. Now, from a secular perspective, the industry is also benefiting from a number of multi-year themes. For example, demand for AI compute, data centers, 5G connectivity, electric vehicle adoption, autonomous driving, and more. These are all significant future growth drivers for the semiconductor industry. Now, beyond this year, industry revenues are forecasted to double by 2030, reaching around $1.1 trillion, driven by robust demand in automotive, data storage, and industrial electronics end markets. With these cyclical and secular forces at play, we anticipate further upside in the chip space. However, we should know the valuations for many of these semiconductor names are relatively expensive. For example, the forward price-to-earnings ratio on the broad semiconductor index is currently in the 93rd percentile over a 5-year look-back, and the median name is trading at a price-to-earnings multiple that's in the 89th percentile. So valuations are stretched, and there are a number of potential concerns about the impact of geopolitics, elections, delayed rate cuts, as well as divergent fortunes of various semiconductor companies given the varying impact of this AI cycle. With that in mind, that's why we look to structured investments to position for the continued growth in the industry in a more risk-managed way. For example, investors may want to use structures with downside protection or some buffer to better manage those concerns while still participating in the upside. And the current options market dynamics can help enable this opportunity. Or on the flip side, investors may wish to narrow down the list of semiconductor beneficiaries by opting for a custom index versus a broad ETF, and those indices are increasingly available. Now, that's your one thing in markets from me this week, but we pick up this very conversation about equities and semiconductors from the derivatives perspective with Amy Wu Silverman, Managing Director and Equity Derivative Strategist at RBC. Take a look at this segment now. My first guest today is Amy Wu Silverman, Managing Director and Equity Derivative Strategist at Royal Bank of Canada, RBC. Amy has spent the majority of her career in the options market and provides options-based thematic ideas to the global institutional and structured product client base. Amy, it's so great to see you today. Thanks for coming in.
Thanks for having me.
Well, it's so much that we can talk about here today because obviously there's a lot going on in the equity markets, rates markets, commodities, and of course your purview, which is the volatility and options markets. And, to set the stage, of course, the S&P, the NASDAQ, the Magnificent Seven have all done exceptionally well for the first quarter of this year. But here we are in the middle of April and things are not going as well as maybe investors have been accustomed to. So as you look across the volatility space, across options, what stands out to you?
There's so much to take in. There's so much to talk about. So maybe I'll just start 10,000 foot view. From an options market perspective, I really think that post-COVID has been its own volatility regime.
Yeah.
And all the relationships that we kind of counted on in derivatives, they really broke apart. And I think you'll recall the GameStop frenzy, the AMC frenzy. A lot of that bid for upside was a big part of it. And it's not just that. The AI frenzy is another part.
Yeah.
But one thing we have seen is option investors have really been focused on the right tail. They've really been focused on somehow getting upside as quickly as possible to the point where call demand is outweighing put demand. That doesn't normally happen. In 30 years of relationships, that's typically not inverted. We continue to see that inverted. The bid to the right side of the normal distribution to that tail was truly unprecedented. And I like to joke, it was the FOMO and the MOMO carrying you that you saw. And the one interesting thing I'll say now, Anastasia, is we are beginning to see an inflection point of worry, which we did not see before. But maybe it's a conglomeration of geopolitical risk, maybe it's the CPI prints, but we are starting to see the left tail wake up, the demand for hedging, and that has not been true the past 4 years.
All right. Yeah, you mentioned the word frenzy. And when I think back about the last 4 years, there's been a lot of episodes of frenzy, right? You mentioned the GameStop type stocks, and, maybe you could argue there was a cryptocurrency frenzy, and, now we have the AI frenzy. So there's been a lot of things to chase in the market. But you mentioned one thing, that the demand for calls has been outpacing the demand for puts. So what does that do for options pricing? Is buying upside participation that much more expensive?
Yeah, so certainly just very simply, upside participation is more expensive. But the other thing it does from a technical dynamic that we're very focused on, and this happened in something like a GameStop, it happened in something like an AMC, is the dealer on the other side also has to hedge what's going on. And that can also exacerbate upside because usually the way they hedge is they buy more shares. So we see these cycles of momentum, first of all. But the second thing I would say is if you want an analogy, it's sort of like investors are dipping their toe in the water, because I think for 4 years we were like, when is this recession coming? When is our hard landing coming? Consensus was just so unbelievably bearish. And we kept getting disappointed on the being bearish part. The market was just much stronger than we anticipated. And so how do you get upside really quickly? How do you get that right tail really quickly? We see it in that options demand, and that options demand often begets more options demand.
Right. Yeah, it's a really important point. And of course, if you're going to sit in a lot of cash, even if that cash is parked in a money market, and yet the market is up, 20, 30, 40%, depending on what you look at, that was the case last year, how do you quickly get exposure? Of course, has been through the upside participation. So how do you square this chase in the market and this in the equities market, options market, for upside versus not actually seeing that materialize in sort of cash instruments?
Yeah, that's really interesting because I think what the options market is doing is it's sort of a leading indicator. The second thing I would say is people like to call it FOMO, but momentum itself is a factor, right? So the idea that when you start to see things do well and you haven't participated and you started to lag your benchmark, you need to participate, and that obviously exacerbates the upside. So one thing we have seen over and over and over post-2020 is when you start to see these large concentration of stocks do well, whether because of AI or simply it's the Mag 7 concentration running, you start to see that bid to the tail get higher and higher and higher because people are starting to say to themselves, hey, I've been consensus bearish. I've been worried about this recession that hasn't happened. I've been worried about this hard landing. And meanwhile, all these stocks I haven't participated in are running. I need to get exposure to that quickly. We often see that in the options market.
Yeah. Speaking of the bearish side of things, do you think investors are right to be looking for more downside protection, or have we already seen the implied volatility for put options spike to where it doesn't make sense to chase that?
I think it's definitely not too late. So when you kind of look at the implied volatility, that cost of protection, on a 5-year basis, on a 10-year basis, on a 15-year basis, we're really still at historic lows. And you've seen investors express it very simply, something just like S&P puts, but you've also seen upside in the energy sector, for instance. You've seen upside in gold from options. And I think these are all variations on a theme. So whether it's a variation on the geopolitical theme, which is where it would lead you to energy, or inflation concern, which would lead you to gold, or overall market concern, which would lead you just simply to the market itself, we're starting to see that worry pick up. But again, on a historical basis, very, very cheap, because the focus has all been the right tail.
As you look across sectors and factors today, what do you think you should be chasing, or what do you think you should be hedging?
One sector that we're focused on is semiconductors. And the reason is because when you kind of go back to the history of the chase, if you will, when the AI frenzy first started, it really started with NVIDIA initially did their first earnings about May of last year. And when that chase happened, it was really just in NVIDIA itself. It really contributed to this narrowness of breadth in the market. But as that stock continues to go up and up and up, investors have started to ask themselves, how are we on this valuation? Are we too full? What are the adjacent names?
Can't be just one company.
Can't just be just one company if this is meant to be a secular theme that's going to drive the market for years and years. And so obviously semiconductors have had a run, don't get me wrong, but we continue to see that adjacent demand. And although that Hall demand is obviously expensive, again, historically, it can go much higher if you use NVIDIA as a proxy to where that momentum begets momentum.
Right. So we've had a lot of momentum in semiconductors. The likes of NVIDIA were up close to 200% or more last year. So far this year, semiconductors are up about 14%, close to that. So, is it still really a sector that investors should feel comfortable chasing? And if so, is there an effective way to do that in the options market?
Yeah, so I'll say two things about that. The first is, one of the indicators that we use to specifically answer this question is this idea of skew inversion. So basically the idea that this call demand is outweighing this put demand, but where are we on a percentile basis? Could this go higher? Can this go more extreme? Because we've seen that in things like AI names like NVIDIA. We've seen that in names like GameStop and AMC. So that indicator is telling us that yes, there's positive momentum, but we think that momentum,
meaning the difference in implied volatility
between those calls and those puts.
Right. Exactly. And the call leg potentially becoming that much more extreme.
Yep, exactly right. And, when we measure that on a percentile basis, is it richer? Yes. But do we think we can actually hit higher percentiles based on what we've seen happen in other underliers that have experienced this frenzy, experienced this bid? The answer is yes. And, I will tell you, I continue to speak with investors, institutions, hedge funds that I speak to who are still looking for these skew inverted names. They're still asking us what's the best trades to express this on something like semis. They're still digging, and they're still basically hoping that this breadth widens of the market to something other than just a handful of AI names.
Right. It seems like the options pricing and sort of the secular fundamental reason to own semiconductors are really aligning quite nicely. And when I think about, what is likely to drive demand for semiconductors beyond NVIDIA, it's because this is not a several quarters, trend. This is a multi-year build out of the artificial intelligence infrastructure. And I think what started as this, demand for compute, demand for GPUs that clearly benefited NVIDIA is now likely to broaden out to, investors thinking, well, what's the infrastructure that's needed?
Yeah.
And, you're not doing that AI crunching most likely, in a server on premise. You're doing that in the data center. And, you need interconnectivity between data centers and, to various parts where you might actually finally need that output and need the data. So the common linkage between that, you need all sorts of semiconductors. You need compute, you need storage, you need memory, you need networking, you need 5G equipment. So that's what I really like about this broadening out of the semiconductor theme as a way to participate in the secular trend of artificial intelligence.
Yeah, look, like Jamie Dimon says, it's sort of like the initial invention of the steam engine, right? Like it's sort of almost a wave of innovation that's going to really touch every point.
Is groundbreaking, and there's a ways to go. And there's a way to effectively position for that in the options market.
Yeah, that's exactly right. So one thing, we're looking for that not only in options, but is also with a partnership RBC is doing with Solactive, which looks at semiconductors. We also have one for blue chip stocks. One thing we like is the balance of high quality company balance sheets versus low quality balance sheets. But look, I think those two things, interestingly, wasn't driven by us ourselves. It was driven by client end demand, because I think people are quite aware of this. But again, they want that breadth. They don't want it to just be one name or two names. And I think you're really seeing that expression through the demand that we're seeing incoming.
Amy, thank you so much. This has been a great discussion about what you're seeing in underneath the hood in the volatility market, and some great ways for us to think about positioning in ideas like semiconductors. Thanks so much, Amy.
Great to be here.
Today, on our Spotlight series, I'm joined by Morningstar Chief Product Officer Vimal Vel. Morningstar is a leading provider of independent investment insights, and Morningstar and iCapital recently announced a partnership to enable Morningstar's 170,000 users with the ability to access alternative investment research and tools to be able to evaluate private assets side by side with traditional assets. So I'm very pleased to say that I'm joined here for this discussion by Vimal here in the studio. Thanks so much for joining us today.
Thank you for having me. Glad to be here.
Yeah, it's great to have you. And so let's start exactly with that. You are the Chief Product Officer at Morningstar. I imagine you've been very closely involved in some of the discussions with iCapital to launch these partnerships on alternative investments. So tell us, how did it come about and what does this mean for your users?
So we've got about 170,000 advisors on our platform, and we've consistently heard from them about the evolving portfolio mix of the different types of asset classes that they touch. And as part of that, two things came out. One is the need for alternatives, and second is the need for a cohesive workflow that enables them to research alternatives, make it part of a proposal, and put it in front of their client as part of their natural workflow. So that was the driver for the partnership. And iCapital's one of the strongest players in alternatives. Morningstar has a very strong footprint with financial advisor ecosystem, and so bringing those two together made a lot of natural sense.
Right. We're thrilled about the partnership, and we look forward to serving your financial advisors. But tell us about the different phases of the partnerships. Where are we, and what has the early feedback been from advisors?
So the feedback's been very positive, and this is something that the advisor community has been looking for. So they're looking forward to having the solution as part of their workflows. We launched phase one as part of the announcement, and then the second phase, when it's broadly available to all advisors, will happen second half of the year. And that's when they'll be able to take that end-to-end workflow of researching an alternative, making it part of a proposal, and then monitoring that portfolio on an ongoing basis for a multi-asset class portfolio.
Right. And so I was a financial advisor years ago, and I remember using the Morningstar Advisor workstation and the portfolio proposal tool. And at the time, it was a series of mutual funds that I could put in that portfolio. But what does this mean today with the iCapital partnership? What are the tools? What is the research that's now available as a result of this?
So the partnership allows us to bring the power of iCapital alternative data into Advisor Workstation and put it in the hands of the advisors as they go through their workflow. So connectivity as part of their workflow is a very important component of this partnership. The second one is taking away that burden of integration away from advisors, because in the absence of something like this, advisors tend to assemble the solution from 2 or 3 different places. This partnership makes it one cohesive workflow capability, so they're able to access it end to end from the place that they are.
Clearly, having that at your fingertips, it goes a long way in adopting alternatives. And to that end, we know from some of the numbers in the industry that maybe 30% of advisors have exposure to alternatives. Of the ones that do, the allocation is something like 3%. But what's your experience with that? How do those numbers square with the data that you see? And, how can this partnership help drive the adoption of alternatives?
So we do this annual Voice of the Advisor and Voice of the Investor survey. We heard 2 things. One was the demand for alternatives exists because this was something advisors were looking for, but they didn't have a solution. The second one, a little bit of a surprising data point, is we learned that about 14% of assets under management for advisors touches alternatives in some form. This was a much higher number than what we had thought. Right? Now, the definition of alternatives might be slightly different depending on who you're asking. But so those two things, one, the demand exists and advisors are solving for some of these things by themselves, one way or the other. So the importance of delivering this as one cohesive, integrated solution was an important step for us to take. So both good indications for our partnership, and it suggests that we are certainly moving in the right direction here.
All right. Well, 14% is a surprising number because we typically hear 3 to 5% as the allocation. But it makes sense perhaps that more advisors are thinking, or at least, have some sort of exposure to alternatives. It seems to me that there's been a lot of wealth tech solutions that have been built over the past several years, which is great news. But at the same time, for a financial advisor, that poses a problem is, which one do I need? How do I integrate all of them? And, how do I bring that all together? So what do you see as a technologist in the wealth tech ecosystem? Do we have to continue to build more, or is it time to consolidate some of the wealth tech that we have?
We hear a few themes, right, from the marketplace. One is a theme that we've all been hearing about, right? Personalization. And that personalization requires an advisor to stitch together different capabilities, potentially from different solution providers. So being able to deliver a solution that brings together best-in-class capabilities from maybe multiple providers is going to be an important component of what we're going to see in the wealth tech space. Second is how much they depend on technology. Right? Traditionally, advisors have not embraced technology as much as they're beginning to do so now. And a large driver for that is because they want to spend more time with clients and spend less time tinkering around with tools. So having better technology, more integrated technology is going to be very important. So our partnership strategy is driven by those two needs we've seen in the marketplace. The first one is just being able to serve a broader set of needs by partnering with ecosystem partners. And second is using our App Hub as a framework to deliver pre-integrated solutions rather than discrete, separate capabilities to advisors as part of their work.
Right, which at the end of the day greatly simplifies the workflow and makes it that much more efficient if it's right there in one place at your fingertips.
Absolutely, so they can spend more time with their clients.
Right, that's right. And Vimal, my last question for you is, what's on the roadmap?
So the App Hub is a framework, right? And what we're now able to do is to identify the needs in the market that are adjacent to our core workflow capability. So Morningstar is very strong in the investment planning workflow steps, and adjacent workflow capabilities, adjacent data and analytics capabilities, those would be where we find best-in-class partners, work with them to build a more cohesive solution and deliver that to the advisors. I think that's the future of the wealth tech ecosystem, is even if you're not delivering all parts of the workflow, it's very important to establish interoperability between different solution providers and be able to deliver to the advisor as a cohesive workflow capability.
That's right. So it sounds like integration and this interoperability is very much what's on the roadmap for Morningstar. Well, it's been a pleasure having you here today. And thank you so much for helping us understand the world of alternatives now within Morningstar. And we thank you very much for your partnership. And we're thrilled to be able to bring the private market research and access to your 170,000 users at Morningstar. Thanks so much, Vimal.
Thank you for having me.
And we want to hear from you. Send us an email at yourquestion@icapitalnetwork.com and let us know what questions are at the forefront for you and your clients. I'm Anastasia Amoroso, and thank you for joining us today. I'll see you next time on Beyond 60/40.